Why are the nation's biggest investors abandoning the Sydney market this month? The entry prices no longer align with rental returns, forcing a pivot toward Perth's shrinking inventory and Brisbane's explosive yield growth. Stop settling for overpriced units and discover how to transition your capital into interstate markets, where the numbers actually make sense. Follow the money, and the trail starts with one Sydney landlord's cash flow ledger. Take an older Sydney property valued at $1.4 million. The weekly rent of $810 generates an annual return of $42,000, showing a headline gross yield of 3%. This reflects a high 45-to-1 price-to-rent ratio. But the gross figure hides the real drain. Once the landlord pays property management, insurance, council rates, land tax exposure, and repairs, the net yield drops to 2.1%. In premium pockets like Vaucluse and Moreton, gross yields compress to 2.3%, pulling net returns below 1.8%. The real squeeze comes from debt. In August 2026, the Reserve Bank of Australia held the official cash rate at 4.35%, locking in high variable mortgage rates. For a landlord with a $980,000 loan, a 70% loan-to-value ratio, interest-only payments at 6% require $58,800 annually. Shifting to principal and interest repayment increases this debt servicing burden even further. Subtracting these costs from the net rent leaves the landlord with an annual cash deficit of nearly $30,000. For years, investors accepted this negative gearing, waiting for capital growth. But as Sydney price growth stalls, the math no longer works. Landlords are undergoing a psychological shift, moving away from capital growth speculation toward a critical need for immediate liquidity and yield. They are left asking how much harder their tied-up equity could perform in other markets. A 4-bedroom house in Sydney demands a median of $1.42 million. In Brisbane, a comparable 4-bedroom property sits at $720,000, creating a major price per square meter gap. While Brisbane's citywide median across all dwelling types reached $1.11 million in June 2026, the market for houses priced below $800,000 remains accessible. This entry point gap is drawing capital towards southeast Queensland, where investors are tracking a multi-year infrastructure timeline. Government commitments include an Olympic Capital Works program worth $5.2 billion, sitting within a broader $22.9 billion transport and infrastructure pipeline. The physical works are only beginning. While the Cross River Rail project hits its operational milestone in 2026, early site works for the Victoria Park Olympic Stadium only start after August 2026 under a contract awarded to BMD Constructions. Peak construction spending will not arrive until 2027 and 2028, positioning the 2032 Games as a long-term economic horizon rather than an immediate peak. The historical effects are showing up in outer ring corridors. In the 12 months leading to June 2026, Ipswich recorded capital growth of 9.3%. Logan reached 8.7%. Moreton Bay hit 8.4%, and Southport grew by 7.9%. By comparison, Sydney's blue-chip suburbs of Moreton and Vaucluse grew by just 1.2% and 0.8%. Yet, southeast Queensland is not a uniform market. Smart acquisitions require verifying localized risks. Pockets of Fortitude Valley face apartment supply pressure with vacancy rates touching 2.8%, while low-lying areas in Ipswich and Logan require strict flood risk screening to avoid prohibitive insurance premiums. Midland serves as the third consented case file, where tenant demand links directly to verified local employment. Land value efficiency serves as a clear lens for this shift. On a price per square meter basis, Sydney commands $12,400, and Brisbane sits at $7,200. Perth offers a lower entry point at $6,800 per square meter. This pricing advantage connects with a tight rental market. In Perth, the vacancy rate for purpose-built apartments sits at 0.7%, while detached houses record a vacancy rate of 1.1%. Newly listed rental properties spend just 4 to 5 days on the market, showing extreme leasing speed. However, this immediate leasing leverage differs from overall sales conditions, and serves as a current signal rather than a permanent guarantee. The tenant pool is tied to specific sectors. While Western Australia's resources sector added 12,000 regional jobs between 2025 and 2026, Perth's local technology employment grew by 4.8%. This metropolitan job growth supports rents, but investors must separate local tech demand from volatile regional mining cycles. A concentrated economy exposes landlords to sudden shifts if hiring slows. Supply is also beginning to respond to the shortage. Although inventory remains tight, developers are averaging 1,200 dwelling launches per quarter. Buying in after a rapid price run-up introduces exposure to rising insurance premiums and higher maintenance costs. Perth stands as a high-performing tactical option for current cash flow, but it remains vulnerable to the broader economic cycle. Selling a median Sydney house at $1.42 million releases roughly $1.22 million in net equity after real estate commissions, mortgage discharge, conveyancing, and capital gains tax. This equity represents a borrowing and risk query, rather than liquid cash. Under a mortgage broker's stressed serviceability calculation, variable interest rates near 6% require an 8% serviceability stress test. If approved, this capital can fund a two-purchase interstate strategy, but the math must be carefully run. Upfront transfer duty on the median NSW property is $55,500. By comparison, Queensland's transfer duty on a Brisbane house priced at $720,000 is $22,000, while Western Australia charges $18,500 for a Perth property priced at $560,000. The tax arbitrage continues with recurring land tax. NSW's general land tax threshold sits at $950,000, compared to $600,000 in Queensland and $300,000 in Western Australia. Holding two properties in NSW triggers an annual land tax of approximately $38,000 under aggregation rules. Spreading this portfolio interstate drops the annual liability to $12,000 in Queensland and $10,500 in Western Australia. However, ownership structures, joint holdings, companies, and surcharge rules can rapidly alter these figures. The two-property ledger must absorb double deposits, duties, valuation fees, insurance, and maintenance costs. On the federal level, the May 2026 Treasury discussion paper raises potential capital gains tax changes. Though no legislation is finalized, ultimately, this multi-state strategy remains viable only if both assets are supported by strict debt serviceability, conservative vacancy assumptions, and a robust cash buffer. The spring of 2026 presents a specific decision window for this pivot, requiring objective analysis rather than panic selling. In August 2026, auction clearance rates highlighted the divergence. Sydney slipped to 48%, while Brisbane reached 62% and Perth held at 58%. Houses in Sydney spent a median of 32 days on the market, compared to 19 days in Brisbane and 22 days in Perth. Sellers in Sydney accepted average vendor discounts of 6.5%, while discounts in Brisbane and Perth remained tighter at 4.2% and 4.5% respectively. But general metropolitan trends mask localized risks. Oversupplied high-rise pockets demand isolated analysis. In Sydney, Parramatta and Macquarie Park added approximately 5,200 apartments, pushing submarket vacancy to 3.4%. In Brisbane, Fortitude Valley and Kangaroo Point added 2,800 units, raising vacancy to 2.8%, while Perth's Elizabeth Quay development introduced 1,400 units with vacancy at 2.1%. Acquiring in these environments demands strict property-level checks on building quality, structural defects, special levies, strata costs, insurance availability, and the concentration of investor-owned units. Real tenant demand must be verified against local employment, transport options, and competing listings. Demographic shifts support this capital flow. Australian Bureau of Statistics data shows a net outflow of approximately 45,000 people leaving New South Wales, with 28,000 moving to Queensland and 12,000 to Western Australia. The remainder of 2026 depends on how these migration patterns, new listings, credit conditions, and construction pipelines shift. A successful pivot relies on strict criteria, higher vacancy allowances, interest rate stress testing, realistic repair budgets, and a clear exit plan. As credit tightens, relying on Sydney's capital growth is giving way to a raw pursuit of yield. Shifting taxes and migration are permanently redrawing Australia's wealth map. The market isn't just moving, it's maturing. Where are you placing your capital? Let us know below.